It's a new presentation, and hopefully everybody will get something good out of it. So we're going to have some fun. Got a lot of material to get through. This is a topic that has really gained a lot of traction in the last few months with the finance world changing, and it's something that during the 90s and we did a lot of, and probably early 2000s. But then since money was free, we probably saw very little of it for a long time, and it's something that there's a lot of misunderstanding about. So we're going to be talking about mastering seller finance and the 1031 exchange. We're going to talk about seller finance and the tax consequences of a seller finance transaction. We're going to talk about two different contexts: you as the buyer and you as the seller, and what you need to be aware of if you're doing an exchange or if you're just looking at it as an end game. So obviously, like everything, this is not a new topic. It's just something that there's a lot of misunderstanding about. And I just sort of get a kick out of it because if you go on YouTube, type something in on seller finance, it's just all over the place right now. And different groups are talking about, all the things you can do with it, which, true, you can do a lot with it, but you just really need to understand what's happening and what the consequences are to the parties involved. And it's a tremendous tool to get deals done. It's a tremendous tool as an end game, and it's something that honestly, my brother and I used a lot of when we got started investing in our little turn and burn properties years ago. So it's a fun topic for me. We're going to talk about note and trust deeds, and primarily just because that's what we typically use. And we will talk briefly about land sale contracts and wrap contracts, and what it looks like, as I said, from the buyer's perspective, seller's perspective, what to look for, what to be aware of. And one of the biggest issues with them I see is that there's so much misinformation out there with respect to when the tax consequences occur on these things, and what kind of tax exposure you're going to be subject to. So once again, David Moore with Equity Advantage, 1031exchange.com. And we like to say, you've worked hard for your money. We work hard to keep it yours. So thank you so much for joining us today. If you are interested in getting CE for this class, we'll give you an hour in certain states. So reach out to cmoore, CMOORE at 1031exchange.com. Celia there will be able to help you with that. And away we go. All right. So I just want to start off real quickly, a little bit of self-promotion here. We like to say, the advantage companies, we like to call it the advantage. And whether you're looking to do an exchange to defer gains on investment property, or you're looking to take your IRA or 401k funds to go out and buy things Wall Street doesn't sell, we're here to help you out. And we can actually even dovetail both of those things into one transaction. It is possible to take retirement money and combine it with personal money into a common investment. It's even possible to do that if you're doing a tax deferred exchange. It's going to require a tenancy in common structure if it's via 1031. But it's something that's, once again, not new. It's been possible since retirement accounts were started in the mid 70s. Understand 1031's been around for over 100 years at this point. And there's not a whole lot of case law there with 1031. There's a lot of misinformation out there, a lot of misunderstanding on 1031s. You think about something that's just a fraction as old, retirement accounts, and it's really one of those fields where it's tough to get information on it. So I like to say, there's only one dumb question. It's the one that's not asked. I always like to say that I'm always happy to learn, tired of being taught. And the best way to avoid being taught is to really take advantage of the resources, the people in your life that are there to help. It's a complicated world. If you're needing tax or legal work, engage people that have been through the stuff, not paying somebody to learn on your behalf. If you're working with real estate brokers, finance people, closers, everybody's got a job to do. Take advantage of those resources, ask the questions of those people, and work as a team. Assemble that great team of professionals, get you where you want to go. So if you're a real estate broker, obviously you're going to have a lot of information here that's hopefully helpful. If you're an investor, you're probably going to be made aware of some things that I hope helps. And really the catalyst for this presentation is we've had a number of transactions recently where the buyers are telling the sellers something that's entirely erroneous with respect to the treatment of that seller carry. and whether it's their ability to do an exchange in the future when a balloon payment comes in, which you cannot do, by the way, or the taxability of that transaction. And I just, once again, if you're selling a property, whatever your instrument you're using, understand it's your instrument. And it better be reflecting your needs and desires. And I've seen blind assumptions structured because the buyer's kind lawyers drawing things up or whatever might be happening. And you need to make sure you understand what you're getting yourself involved with and what it's ultimately going to mean. So in the scuba diving world, they always say if there's a problem, your first thing you're going to do is stop. And you're going to think about what's happening and where you're going to go with it. In this situation, don't get yourself in a situation where you're being rushed through something. Understand if it's a seller carry transaction, it's going to complicate things if you're doing an exchange. If you're just selling the property, you want income, make sure that you're really taking advantage of the professionals in your life and understanding, one, the tax consequences of accepting that transaction, and two, make sure that it's reflecting your best interests. And once again, as a buyer, obviously it's a tool to get a deal done, whether it's a property that maybe can't be financed, or maybe it's a situation where you just need to get a deal done quickly. All these things can be accomplished with a seller carry that can be structured very quickly and get you where you need to go. So we like to say, in here, we don't provide investment advice. We don't sell investments. We're here to get you where you want to go. We've got one objective: provide solutions to your investment needs. So that brings you back to those questions. And as I've said about asking those questions, I will say that I'm probably not going to address any on the sidebar today. But please, if you've got questions or concerns about something we're talking about, please don't hesitate to reach out. We'll address any of those questions with any feedback going forward in the future. And also, if you've got questions on transactions, some particular topic that you'd like more information on, please don't hesitate to take a look at our YouTube channel. It's a very robust channel. It's got information on everything from selling life insurance contracts, cost segregation, charitable remainder trusts, obviously the 1031 stuff. But if you don't see it there and you want us to put something together for it, we'll be happy to do that. So we're always looking for topics that you find of interest or are needing information on. So first off, I just need to make sure, since we are talking about using these instruments in a 1031 context, we're going to establish a baseline knowledge. If you've been on my classes before, I'll apologize a little bit, but I just really think it's important everybody understands the basics of the exchange, and we're going to talk about all the ways to use seller carry. So when you're looking at any exchange, I was always taught it's not a tax, legal, or escrow decision. It's purely an investment decision to do an exchange. You're choosing to keep your money yours and move it forward. Every dollar you save, you're going to have $2, $3, $4 or more dollars to reinvest. There is a time issue there. Obviously, the opportunity cost of the exchange comes at the expense of time. So you need to understand what your tax it's going to be on a disposition before you enter into one. Make sure that you do what is right for you. Once again, the exchange isn't always the right opportunity there. So if you've got a very small gain, maybe you don't do the exchange and you pay the tax, and you've got patient money. In a market like we're in, those with gold make the rules. So the opportunity cost of the 1031 is you've only got 45 days from settlement to ID what you want to buy, 180 days to get the deal done. So if you're concerned about those timelines, understand if you enter into an exchange, you're going to be married to us for 45 days. We can't just terminate a transaction at will for you. There's something called 1031 G6. If you want to know more about that, once again, take a look at our YouTube channel. But in a nutshell, we cannot give you money until you've purchased everything you have the right to buy, which you can identify anything you want inside that 45 days. So we cannot give you money for any reason inside the 45-day ID period. So when you start that exchange, you're going to be stuck with us for 45 days. At that 45th day or inside the 45 days, you better be either committed to completing the exchange at that point or terminate the transaction, because if you don't terminate it then, the money is going to be locked up with us up until day 181. So just be aware of that, and really really more importantly than ever before, it's planning what you're doing here, understanding the timing of the transaction and what your options are going forward. So why do we even think about exchange? Gain is one of those issues that people really don't think about. That I mean, they think about it, but they don't truly understand what's going on. And I want to stress, whether you get any money out of a deal or not, that's totally irrelevant when we're looking at gain. Gain is simply the adjusted sales price minus the basis. And what do I mean about the adjusted sales price? Adjusted sales price would be the gross net of closing costs. Normal transactional costs can be paid without any tax consequence. A normal transactional cost would be considered broker's commissions, title escrow fees, tax and legal fees, current property tax prorations, that type of situation. Now, anything that's outside of that is sort of subjective between you and your tax people. You want good tax people in today's world. Get a good CPA, somebody that's familiar with this stuff, works on it. Don't just hire a tax preparer if you've got a bunch of property. And really, people say, well, gee, it costs too much. Well, it costs you too much not to have good tax counsel, in my opinion. I think good tax people are the most important people in someone's life today, especially with the government hiring more auditors and everything else going on. Understand, making that money is one thing, but keeping it is quite another. And that's really about what that 1031 is about. So let's say a lender required repair. Is that a normal transactional cost? No, it's not. So you're going to have tax consequence on that money that's used to pay that lender required repair. And then the question is, well, what does that really mean to you? Tax exposure is one thing, taxes owed is quite another. So you're going to have a powwow with your tax people. Can you maybe offset the tax exposure by expensing that item and ultimately mitigating the tax consequence? And that's, once again, that conversation you're going to have with your tax people. That's just one example of what's there. So once again, having exposure is one thing, taxes owed is quite another, and that's where the good tax people come in. So we talked a little bit about adjusting that sales price. And by the way, even if those transactional costs, if you sold at, let's say, $1 million, you might have 60,000 or 80,000 closing costs there. That's going to reduce what you have to spend to go buy that replacement property for total deferral. It's not the gross sales price, it's really that net number. And then also think about, let's say, back that lender required repair or other things that are going on, maybe a seller's concession to the buyer for something. Well, that really, it's going to come back to how that tax person treats it with you, but they're typically going to treat it as a reduction in sales price. And it's going to reduce what you have to spend for the exchange. Now, whether something is boot or a normal cost, either way, you're not going to pay tax on these items twice. So they reduce what you have to spend. So a lot of times people think, hey, I sell at $1 million, I got to buy at $1 million to be totally deferred. That's not true. It's going to be something less, and that's that number you're going to crank out. Ask your broker for a net sheet and go talk to your tax people. Get those numbers. As soon as we have a final settlement statement, we can actually really see what's going to happen there. And you talk to your tax people once again with that settlement statement, and they'll be able to crank that number on what you have to spend for total deferral. So what's the basis in the property? It's the purchase price plus capital improvements minus depreciation. Well, each of those has a number next to it. Why does each have a number next to it? Because the purchase price varies depending on how you got the property. If you were gifted the property, your basis is what the person that granted the gift to you had. If you inherited the property, you got stepped up basis current market value. If you pulled money out of your pocket, it's the purchase price. If you did an exchange, you had a basis carry forward into that purchase, into that property. So you have something less than what that purchase price was. 1033, involuntary conversion, that's tax deferral. Once again, that's a basis carry forward transaction. If you sold, let's say sold a home pre-1997, 1034 was something where maybe you had a base carry forward type situation there too. So you got to really look at what's going on and understand what's happening there with those transactions. But 1034 is gone. We don't worry about that. We've got 121 on a home sale today. 121 just a straight exclusion on gain on a sale. So we're not worrying about tax deferral in those transactions. But really look at what's happened through the years, and that purchase price varies depending on how you got or received that property. Improvements, well, everything you put into that property during the time you own it, you either capitalize expense. or expense it. If you capitalize it, it's going to increase the basis. If you expense it, you wrote it off, it doesn't impact the basis. And then depreciation, understand the big thing with depreciation is that you've got to understand that if the government deems you should have taken it, you therefore did. So it's possible that you might have had a property that by law you were supposed to take depreciation on. You didn't do that because maybe you didn't have good tax people. And now you've got a situation where you got audited and they're going to say, well, gee, you did take it, whether you got the benefit or not. You didn't get it personally, that benefit, because you didn't take it, but we're going to treat it as though you did. And now we've got a tax consequence without the benefit of having used that during that life of those investments. So once again, that's a good reason to have good tax people. So, gain is simply the difference between the adjusted sales price and basis. And if you notice, I didn't say anything. There wasn't a comment made about receiving any money out of a transaction. So in the middle of this page, there's a bold word, 2 words that say phantom gain. And that's one of those things where if we look at the last crash, we did a number of transactions where people maybe lost a property foreclosure or short sale, and they're thinking, well, gee, I don't have any taxes because I didn't get any money out of this thing. Well, it's totally untrue. Phantom gain occurs when the debt on a property exceeds the basis. That difference, but the debt is treated as a sales price. So once again, sales price minus basis is gain, and so these people would have lost a property, lost all the money in the property, and to add insult to injury, they would have a tax consequence on that loss. And if it was your primary residence, you had tax relief. Income properties, you don't. So just really be aware of that gain has nothing to do with a debt on a property. It has nothing to do with any money coming out. It's just merely a tax calculation. And as this market continues to do what it's doing, I would expect, I think there's a lot of people that sort of grew out of, we had over a decade of just nonstop increased growth in the real estate world, increased in values. And I think a lot of people, if you could, steam a mirror, you were making money in that space. And I think there's probably people that sort of migrated out of houses and into more commercial type properties. And think about the fact that any let's say even multifamily over 4 units, under 4 is typically financed as a residential deal. In excess of that, you're looking at more investment type loans. And instead of having 10, 20, 30, 40 year money, now you're looking at maybe 5, 7 year money. And as these loans are coming due, you think about the loan where it was with the interest rates and what's happened with the value of those properties. Now we're going to have a situation where you might have, capital calls needing to inject more money into an asset to get it refinanced. And regardless of that happening or not, you might have a situation where you're looking at it saying, hey, now with the new interest rates, the property is not going to do what it was going to do. I can't afford to keep it. And the thing ends up going away because you can't get a loan on it. So be aware that as things, if they continue to go the way they are, these are the type of transactions we might see starting to rear their ugly heads once again. And it's just one of those things that people really don't comprehend or contemplate because they really just, hey, I didn't get any money. How can I have any tax? So what's a tax hit? Why do we look at this? Once again, we're looking at, these are long-term capital gains tax rates. Typically, we're looking at a 20% Fed on appreciation. States are going to vary anything from 0 to up to 13 potentially. Depreciation is going to be recaptured federally at up to 25%, and then we've got healthcare on top. So do the math here. You've got 30 to 38% or so tax hit, assuming it's a long-term gain. A big misunderstanding with 1031 is hold periods. Well, gee, you have to hold the property for X to have it qualify for 1031. It has to do more with intent than time. I can give you a court case where 4 months was deemed long enough in a 1031 transaction. Not that I necessarily agree with that. Typically, I'm going to tell somebody, let's see, a year anyway, and that's based upon 2 factors. One, it's been proposed a couple times, and 2, that's the break between short and long-term tax rates on assets held for investment. But if you're thinking about a situation where maybe you bought a property and you're selling it inside a year, even if you held it for investment, you're looking at normal income tax consequences, not long-term capital gains tax consequences of that situation. The reason I bring it up is you could qualify for an exchange. Now, if you bought the property and it took you, let's say a year to fix up, and upon completion of the improvements, you go to sell it, once again, that could take 2 years. You're still looking at normal income tax, not long-term capital gain, because you held the property for resale, not investment. Furthermore, it's not going to qualify for 1031. So just be aware of those things. And once again, plan for what's going on, assemble that team, and instead of buying, fix, and turning, you're going to buy it, fix it, hold it. Maybe you do a cash out refi. Maybe after a year or two, then you do an exchange. The refi money's not taxable to you. When you do the exchange, you're going to satisfy that, deferring all the tax obligation down the road. So there's ways to get out of that trap. But if you're just buying, fix, and turning, you're going to get very tired of paying the taxes on that stuff, and you're just going to eat up your profits. So think about that, and once again, get that great tax people in place to help you keep what you've worked so hard for and keep it yours. So this map just sort of shows, and by the way, this slide deck will be available to everybody after the presentation, and also this presentation will be back up on YouTube for you to review again later if you can't get enough of it, or maybe you're just trying to get to sleep some night and you turn it on. Hey, I'm okay with that. Instead of taking that sleeping pill, just go and listen to David. Anyway, this map will give you an idea of not only what tax rates are where, but also where the money is moving, because typically those states that you see in gray are going to not only have no tax consequences on as far as state tax, but also you're typically going to have more ownership rights, which is something that seems to be a continual erosion in today's world. So just keep that in mind, and I just really like that map. Few examples of things that I hear over and over and over again that are just wrong, dead wrong. We're going to hit them real fast. One, like kind does not mean house for house, land for land. It refers to the nature of the investment rather than the form. So you can, any real property held for investments like kind with any real property acquired with the intent to hold for investment. So you can go from rental house into apartments and into dirt, into industrial. It really doesn't matter. It's just that nature of the investment rather than the form. Two, 1031 does not require a 2-year hold. I don't know how often I hear this, and what's really funny to me is we kept having questions on a 5-year hold. Our #1 viewed video is the fallacy of 5-year hold, and that has to do with a property acquired via 1031, converted into a primary residence, later sold. But I want to stress that the 2-year hold in a 1031 applies to a related party transaction. So if I were to exchange properties with my brother, in that context, a related party transaction, then there's a 2-year hold there. If you read the fine print, even in that situation, it's not an absolute, but that's where the 2 years come in. If you're looking at a hard line number on how long you have to hold something, it doesn't exist. So it's totally up to you and your tax and legal people, what you've done with the property during the time you've owned it, what you did with it, or what your intent was when you bought that thing. So we typically look at this court case, the Clarkowski court case, 9 points used to determine dealer status, and that's going to sort of help us figure out what's going to fit or not fit for people. All right, so I want to stress once again, there's no set required hold in 1031. 3, there's no limit to the number of properties relinquished or received in an exchange. Now, the identification rules imply that there are. The identification rules, there's 3 rules, each works independently of the others. The first one just says you can ID up to 3 properties of any value, pretty clear what that means. 2, you can ID more than 3 properties, total value of which cannot exceed 200% of the relinquished property's value. And then the 3rd rule says you can ID more than 3, the value can exceed 200%, but you got to close 95% of the aggregate value of all properties ID'd, which means that you're buying literally everything you've identified. Yeah, one sale fail, you got a problem there. So once again, you can do whatever you want inside the 45 days. And we've got a number of transactions through the years where we might take a dozen relinquished properties, buy 1. We might take 1 relinquished property and buy a dozen replacement properties. This really doesn't matter. Any number of transactions, properties can go in and out of a transaction. We've just got to make sure that the ownership is going to be the same. The taxpayer that relinquished has to receive the replacements. For today's topic, you can carry a note trust deed or land sale contract and do an exchange. I'm not going to spend any more time on that because we got a whole bunch on that coming up. 5, you do not have to replace debt in a 1031. Now, what's happening in today's market? You got loan to values being reduced. People are having to inject money. You typically might have a reduction in equity, which converts to a reduction in actually net proceeds coming out. And so there's a number of times today in today's world where people are having to inject money into a purchase to get a deal done. And I'm going to tell you, that is totally fine. Debt can go away 2 ways. One, by going down in value, which triggers tax because you went down in value. The other way debt goes away is by adding cash into a transaction. So I just yesterday, I had somebody say, well, look, you know, I don't want to have any debt on the replacement property, so should I pay off the relinquished property pre-close? Totally unnecessary. Just show up at the purchase with the additional money that's offsetting that debt, and you're going to be totally deferred in that situation. Finally, 1031 is not all or nothing. Okay, so you know, every dollar you spend over your basis on a replacement property represents tax deferred gain. Defer what you want to defer, or maybe you've got losses elsewhere to offset the gains here, because this is one event, right? It's not what you're looking at over the year. Now, you know, we're looking to today is April 10th. So, you know, people are busy trying to do tax work right now. And a lot of people might have only talked to their tax people for the first time, maybe within this last month. Don't do that. Talk to them before year's end this year for what's happened this year. Plan to figure out what's going on. Maybe you've got a gain on the property sale, but maybe you have some losses in Wall Street. Offset the gains with the losses. So really take advantage of the professionals in your life. You know, let them do their work and do some tax planning for you pre-year's end. Don't wait until you're looking at a baked situation on taxes and gain and filing a return. Really use those people. Don't just use them, you know, to file a return. Use them for tax planning, and you're going to be a lot happier. Financial advisor is going to be happier, but really take advantage of those professionals in your life. Exchange cornerstones, something's got to be exchanged. What's going to receive your like kind to have to go across or up in value and equity. We call it a napkin test, and we've got to have continuity of vesting. So it looks like maybe you're going to be able to see what I've got here if I'm just running it through this way. So hopefully you'll be able to see what I'm talking about on this. Continuity of vesting, the biggest issue with any exchange is time. Continuity of vesting is the next biggest issue there, and it's just such a problem because, you know, even depending on the state we're living in, you know, for example, a limited liability company, I'm speaking to you from Oregon, and in Oregon, husband and wife as members of a limited liability company. We're not a community property state, so it's a legal partnership. So to go in and out of an LLC in Oregon, even as spouses, is problematic. Partnership interests are specifically prohibited from 1031 you know, exchange treatment. So we have to be careful with what's going on. Understand, title to a property doesn't necessarily indicate ownership. It's really the benefits and burdens of ownership that do. And in today's, you know, seminar, we're talking about seller carries. And for example, if you use a land sale contract, title remains with the seller, even though the buyer is the owner of the property. A note trustee, that transfers title to the buyer, but you know, once again, that deed doesn't necessarily indicate ownership. Furthermore, you could be married, you could own a property personally, or maybe you're married, and you know, the deed only shows one of you on title. Well, if you file jointly, both of you are enjoying the benefits and burdens of ownership. So you're going to talk to your tax people about, you know, on a disposition or acquisition, if you want to both be on there, we want to clean that up, perfect the title on it before the thing goes away, because otherwise we're going to be looking at things going forward. I've actually had people quit their job in the middle of an exchange. And it's like, well, okay, now they can't get financing. Now they have to add someone else to title to get the purchase property done. And that obviously is not the best situation. So really, you know, if you're contemplating a job change, you're middle of an exchange, don't quit. Complete the transaction, get the property financed, and then do what you're going to do. But, you know, it's really sort of crazy, a lot of things that happen through the years. All right. So seller finance and taxes, this is my big pet peeve with this stuff, all right? Because everyone's throwing up, you know, the buyers there's a whole group of people out there right now that are used to flipping properties, doing other things, and their genius new ideas. Oh yeah, we're just going to do everything, you know, nothing down or on a seller carry. And you know, I've actually had transactions where buyers are telling the seller that they don't have any tax consequence until the balloon payment comes in, or they can do an exchange when the balloon payment comes in, or they'll have blind assumptions in the paperwork, and all these things are, you know, great if everyone agrees to them, but people need to understand what's going on with this thing. So, you know, I'm going to say this right now. Okay, you sell and you carry paper, whether you receive a single payment or not, you could be subject to taxes on debt relief and depreciation recapture in a year of disposition. So make sure you get enough of a down payment to cover all the closing costs, because I've actually sat in a closing where it's nothing down deal too, and escrow wants to get paid, the broker probably wants to get paid, I want to get paid, and anything else that needs to be paid out at settlement, you're going to be coming out of pocket for if you didn't get enough down payment to cover those things. In addition to those, I'm going to stress once again, if you had debt on the property that went away, you could have tax on debt relief in the year of sale. And also, if it was an improved property and you took depreciation on it, you're going to have tax on depreciation recapture in the year of disposition, even if you didn't receive a single payment. So make sure, if you're contemplating a seller carry, that you understand what the tax consequences are going to be. Talk to your tax people, get that bottom line before you agree to anything. Don't be pressured into taking this deal. Now, if you're doing an exchange, it's even more complicated, because typically that paper, that seller carry, represents equity. Now, if we go back to the page talking about the napkin test and what has to be done to satisfy the transaction, we need you to, you know, go across or up in value and equity for total tax deferral. If that note is not used somehow in the exchange, the value of the note's going to have taxes. So we need to do some things to make things work, and just be aware of this stuff. And once again, I want to stress that if you sell and carry a note, and you're saying, well, gee, I'll just do a 1031 when that thing gets ballooned, when the payment when the note gets paid off. No, you're not. It's too late at that point. The exchange has to be structured at time of disposition. If that note's to be accepted, you need to understand how we can use it going forward, and that's why you're on this call today. All right, so just know these things and understand that if you're the seller and it's your paper, whether it's a contract or note and trust deed, maybe the buyer's nice lawyer's doing the paperwork for you. No, you better get that thing in front of your tax and legal people, understand what it says and what it means, because I've seen transactions where we've got blind assumptions in there. And you know, the seller's thinking one person they're selling and that person's going to take care of stuff. Or maybe that's a situation where the seller wants an installment sale because they're tired of the terrible T's, tallest trash tenants turnover. They just want income over the note over years. And if they didn't put an acceleration provision in there, something they thought maybe would have a 10-year timeline is now getting a balloon payment 6 months into it, and they didn't get at all what they wanted. So, you know, understand what it is and what you're going to do with it, and make sure you're protecting your interest. As we always say, you've worked hard for your money. We work hard to keep it yours. Take advantage of those professionals. What kind of forms do we typically see? We see note trust deeds are the most common today. We see land sale contracts. We see wrap contracts. I haven't seen wrap contract in a number of years, but you know, if we look at these things, note trust deeds primarily what we see today. And in a nutshell, you know, a lot of times the escrow companies will actually draw these instruments for you. And we're just doing a seller carry, and you've got a note that's secured by title of that property that you just sold to the buyer, and they default, you get the property back. The neat thing about a note trust deed transaction, well, neat things that I like about one, is it's easily used in an exchange, because what happens is the note just comes to us as the cash does at time of disposition, and we have a series of things we can do with that. We'll talk about those. The other thing that's nice about them is that if we have a situation where maybe you sold to somebody and you ended up maybe buying the note, a lot of times the note is purchased back from us completing your transaction, or maybe you didn't do an exchange, just carry that paper. Well, if the buyer is somebody you like working with, even, you know, let's say they decide to sell the property, instead of taking a balloon tax hit upon a sale and that note getting paid off, you can elect to do an assignment of collateral into that person's next property. So you're not limited or restricted to that one security instrument. That thing can be changed. All right, so I really like that aspect of them. If we're talking about a land sale contract, you're going to need a lawyer to draw that up. It's for a specific event. So, there's going to be some more costs involved, but also since you've got your lawyer drawing the thing, it can actually be drawn in a way that really takes care of you and gives you exactly what you want. The general idea with a land sales contract is they're easier to foreclose because you never gave up title of the property too. So it's easier for you to control that transaction. Maybe they're a little bit safer. They are more difficult in the 1031 context. The other issue is they do not allow an assignment of collateral there. And then wrap contracts is something we don't see very often at all anymore. And that's just because a lot of escrow companies just won't even close it, because what you're doing is you're selling a property that still has debt on it to let's say an institutional lender, and you're not paying that debt off. So you've got a new contract that's wrapping that first. And so you're selling that property to somebody, not paying off the underlying loan that you've got. And I guess, the risk of that is if you're the seller, that the lender finds out that transaction happened, they could call the loan, and that same issue can be a problem for you as the buyer. For the seller, there's a right of remedy. There's a period where you've got a right of remedy where you could fix it and maybe save yourself. But as far as the buyer, you might be in a situation where they call the loan, it doesn't get handled, and you end up losing the property. So really make sure, if you're looking at a wrap, that one, you're going to find somebody that's going to close the deal for you. But two, understand, once again, you better have good legal advice in there as to what's going to happen in a default, or if a bank finds out, hey, this thing changed hands and they weren't paid off, because they have a tendency not to like that. So how do we deal with a seller finance in an exchange? Well, we've got a variety of tools. As I said in the fallacy page, a lot of times people say, well, you can't do an exchange if you carry paper. Well, it's totally untrue. There's 5 different things we can do here. What happens at close is the note becomes ours, all right? And then it's just going to be used somehow through the transaction. Once again, the note represents equity, typically, not always. In a wrap, it might not. But typically it's going to represent the equity. So for total deferral, we need to carry all equity forward, which means that when the note comes to us, we now have these options. We could sell the note to a third party. I rarely see that happen these days. Now, our sister company, IRA Advantage, we have lots of people that come to us, want to self-direct their retirement accounts because they want to go buy paper or make loans by notes, and so that would be a source, obviously, where you can sell something. But as far as selling these notes these days, they're typically, the discount might be in excess of the tax consequence. That I don't see that happen that much right now. I don't know why. I think they're neat. I think they work great for people. 2, use the note to acquire replacement property. Once again, you as a seller, the buyer, you knew the property, that's a security instrument there. But when you're trying to use that note to go buy something else, does that seller of the replacement property know anything about the buyer or the property? Do they want anything to do with either? So that doesn't happen very often. I have had it happen where actually we had the note cross-collateralized. So maybe our exchanger actually has to allow them to encumber something else they have in addition to the property that they sold on the note trust deed. So that can happen. It's just, once again, be prepared if the buyer, really understands what's going on there, or the seller, the replacement, understands what's going on there. Maybe they don't want to do it, and that's obviously totally understandable. 4, short-term note maturing before the acquisition of replacement property. That can happen for a variety of reasons. Maybe the financing blew up for the buyer and you still want to do the deal. Maybe the property's not financeable. Maybe you just needed to do it for whatever reason. Well, we wait. So the note, once again, is ours. And as soon as it balloons, now we've got the money to complete the transaction. Obviously, that has to happen within 180 days. You probably ought to have it happening inside the 45, so you've got the money to go buy what you need to buy. And that's going to dictate what you're doing with respect to identification and or whether you want to complete the transaction. Really, that 45 days, it's critical. You're either committed to completing the exchange at that time, or you just say the heck with it and do whatever maybe you look at a QOC as a fallback for a blown 1031. Right? 5, a partial exchange. You can always do an exchange of just the cash that comes in, the down payment, but that's only going to accomplish something. So you get installment sale and note, but the down payment you can do the exchange on. Now that only makes sense if the down payment is in excess of the basis on the property. So every dollar you spend on replacement property in excess of basis represents tax deferred gain. So 5 can, take care of things, and you can go work to, get where you want to go if you get a large enough down payment. But typically we're not seeing enough come in to make that number 5 an opportunity that gets used, very much at all. So just be aware of that. 5 different ways to handle it. And so it's not yes or no, I can or can't do it. It's really a question of how you're going to get that thing done. All right, so we talked about in a delayed exchange, those are our options. Now think about in a reverse exchange. Now, obviously that's a totally different direction in a transaction. And one thing I really want to say about reverses right now, because we've had a number of transactions recently where people maybe had the sale of their relinquished property blew up for whatever reason, but they still wanted to buy the replacement. And somebody says, well, hey, just go ahead and buy that property. And then when your property sells, at that point, you can do the exchange. No, you can't. You cannot legally own the replacement and the relinquished property at the same time. It's got to be structured as an exchange. So before you sell or buy anything, if you're contemplating exchange, call us, talk to us, understand what you need to do to get there. So, in a reverse exchange, in a delayed exchange, that note can be a problem. In a reverse exchange, and by the way, in a delayed exchange, buying on somebody's seller carryback, totally fine. So I don't care, where you get the money to buy a property as long as it's legal. So, we talked about earlier buying using qualified money, IRA 401k money. Yeah, if you're in an exchange and you want to go buy and have a seller carry, have the seller carry, that's totally fine. No problem at all in the exchange context. It's just if you are the seller in an exchange carrying paper, that's where the issue is. Now, with that said, in a reverse exchange, think about what happens. And in a reverse exchange, even though you're going to carry the buyer finance-wise, I just said you couldn't do it. Well, in this situation, you can. So never say never. What happens in reverse exchange is if you needed, let's say, $500,000 to go buy a property, that's a down payment. Whatever it takes or whatever is needed to close on the replacement property is in effect loaned to the exchange company to go buy that property. So when we buy that property on your behalf, we have a debt to you for whatever the down payment was or whatever the purchase was if you bought the thing outright. Now, typically, we repay that debt to you with future sales, with the cash coming from future sales. Now, if you did, instead of getting cash, you have maybe some cash and you did a seller carry, well, we're just going to take the cash and seller carry that note and use those things to repay the debt we've got to you. So in a reverse exchange, even though in an exchange, typically you as a seller don't want to carry paper, in a reverse exchange, we've got a debt to you and we can use that seller carry to repay that debt to you. So that's a really sort of fun fact with reverse exchanges, totally outside what we normally look at with delayed exchanges. And it is possible to use and very easy to use your seller carry in a reverse exchange on that relinquished property. Now let's say you're looking at an installment sale as the end game. And as I said earlier, you're tired of the properties, tired of dealing with rent control, tired of dealing with the tenants, tired of dealing with squatters, whatever it might be in today's crazy world. And you'd say, well, the heck with it. I just want to have an installment sale. And I'm just going to have that tax consequence, get installment sale treatment, pay taxes as the money comes in. So every payment you receive. So once again, at time of disposition, if you had debt on a property, you'd have tax on debt relief. If you have depreciation that you've taken on it, you would have depreciation recapture. If it's a piece of dirt that's unencumbered, you don't have either one of those things. And then you're going to pay long-term capital gains tax on the principal payments as they come in over time, and then you can pay normal income tax on the interest component as each payment comes in over time. And just understand those things. The risks on that seller carry, if you're doing it as an end game, make sure you've got an acceleration provision in there that's going to allow that instrument to stay in place as long as you want it to stay in place. And then as far as just tax planning. Get your people's eyes on it, make sure it's representing what you need to do. Now, you always have that risk of default too on these things. So, they just be prepared if you're going to do this. one, make sure you're getting enough down where it makes sense to you, and then be prepared to get that thing back. I had not a transaction, I had an exchanger. This was probably 20, 25 years ago now. Sold the same property 3 or 4 times on a seller carry, got it back each time doing exchanges. So it's sort of screwy deal, but just be prepared for that stuff. So if you want an installment sale treatment, and actually it's better than, but you could have an institutional installment sale called a structured sale. So you've probably seen ads on TV on structured settlements. Well, that world sort of morphed into structured sales in real estate. So basically what happens is the obligation to pay, you could have a cash sale that gives you installment sale treatment. And what happens is a third-party assignment company comes in assuming the obligation to pay you, and then they pay you over the term that you've set things up. And that could be just a number of months. Maybe you have a sale that's happening this year, but you don't want to trigger the tax this year. You want it to be triggered next year. So that structured sale could be structured just to maybe last for 6 months, and that gets you from one year to the next and accomplishes your tax planning strategy, and then boom, it gets paid off. So structured sales can be neat because they're going to pay you off over the term that you want to get paid off. Now, there's another option that's really becoming in vogue. It's certainly not the total end all for the stuff, but I really like them, and it's not right for everybody. But a 721 UPREIT is a really cool instrument, and it's going to allow you sort of installment sale treatment plus, because you are going to complete an exchange into a Delaware statutory trust, a DST. And so DSTs were created around 2000. It's fractional ownership of an asset or multiple assets. And basically you're going to buy into this DST through the exchange, deferring all your tax. So upon disposition, you're not going to have tax on debt relief depreciation recapture. You're going to exchange into this thing, satisfying your exchange being totally tax deferred. Well, a year or two after acquisition, if this DST has a 721 option there, what's going to happen is your DST ownership is going to be rolled into what's called a 721 UPREIT, and at the end of the day, you're going to own shares of a real estate investment trust. Now, what I love about this is that you have deferred all your gain, and then you're going to choose to pay tax as you choose to pay the tax. So as you sell shares of the REIT, that's when you're going to pay the tax consequence. But it's actually better because you've got some preferential tax treatment, because you actually have the ability to sell shares on the equity, or not the equity, but your basis component first, and then you're paying tax on the gain at a later date. So we're going to have another seminar on this topic, on DSTs and 721 UPREITs, and we're going to go over this stuff in detail. So I'm not going to spend more time on it now, but I really like this instrument for people that are just looking for a way out. The downside of the 721 is that as soon as you have your interest rolled from the DST into the REIT, your tax consequences are cooked. And what I mean by that is there's no way to get out of it in the future with another exchange, where normally you exchange in and out of DSTs all day long, no issue. When you go into the 721, at that point, anytime you sell anything at that time, you're going to have tax exposure. But what's really nice for estate planning purposes, I don't know, I've worked with a lot of people for over 30 years now, and as people are getting older, they're unfortunately getting some health issues, and sometimes I've got people that say, well, gee, I might only have another 6 months, year, 2 years. I don't want my spouse to have to deal with my properties. I don't want my kids to have to deal with these properties. And just as an estate planning tool, this is a great instrument, because you exchange into the DST, totally deferred. Those shares are then your interest goes into the REIT shares, and then when you become an angel, your heirs can sell those REIT shares with no tax consequence, because at least in today's context, April of 2024, we still have stepped up basis on passing, so they can sell those shares with no tax hit. And it's really just a neat deal with that said. So, I like them. They're not for everybody. And you'll also understand that at the end of the day, you're owning shares of a REIT. So just like anything, values can go up and down. REIT shares are obviously more liquid than just straight real estate. If you talk to your financial advisor, say, hey, I want to take my IRA 401k and go buy some real estate, they're going to sell you a REIT. Well, that's an entity that owns real estate and that you're buying shares of, right? It's not that you're buying real estate. So that's where the DST comes in, because they sort of work like a REIT, but you still actually own and get the benefits of owning real property. But we'll do a seminar on this topic, and you'll get a lot more details on it. If you got questions on it, don't hesitate to reach out. We got a number of great providers in that space, and it's something that I think is very interesting and definitely useful. Couple more slides, we're done. All right. So these are some examples. These are all deals that we've done and how they've been used. So recently, there's been a number of transactions. Obviously, with tighter financing, things just blow up. So maybe the buyer and seller both have a deal that's set. Maybe the seller's got a real estate transaction they've already worked the purchase for, and they're excited to have the sale and do their exchange into it. Maybe the buyer is in an exchange and their 1031's 180th day is next Tuesday, and their financing just blew up and they don't want to blow the transaction. So, a short-term seller carry can really solve a lot of problems. So what happens is basically you shift gears, you do that short-term seller carry back, the note comes to us at settlement. As soon as the permanent financing comes in play, that note gets paid off. We then have the cash to complete the transaction, getting people where they want to go. So this has happened, like I said, a number of times recently, and it's just something to be aware of. You're not stuck in the water if you're a broker. I know you're looking, gee, I thought I had it closed, now I don't. Maybe if you're the buyer or seller, you thought, hey, I really needed to move forward, and now I got this problem. Well, there's a way to save it. So when you're looking at this stuff, I've got a good buddy that always says, hey, if you never ask, the answer is always no. So just be aware there's options out there and things that can be done. Two, we've got a situation where maybe the property is not financeable, right? So in a situation where you got to get the deal done, and my brother and I used to do a lot of this stuff. I mean, we just have the seller carry us over whatever period of time we needed. And so in this situation, we've got a number of transactions where, gee, the lender says, hey, I'm not going to finance it because of this and this and this, and the seller's not wanting to put the money into it, and whatever needs to happen needs to happen. So in that situation, once again, just like the failed financing situation, this is another example of failed financing, but it's not because of the world, it's because of the property. And so in this situation, you can go out, get that property, get the transaction done. Once again, the note is ours at settlement. And when that property is then improved to a point where it can be financed, the permanent financing comes into play, the money comes into us, pays off the note, and we've got the money to complete the transaction, get people where they want to go once again. And this last example, it's just a situation that comes up all the time. People think, well, gee, I want to pull some money out. Anytime somebody comes to me and says, hey, I want to pull some money out at close, I'm going to ask them, well, why? What are you going to do with it? Maybe we've got some other options there, but understanding, or they might ask, hey, David, I want to pull 50 out, 100 out, whatever it might be. So I tell them, that's fine, you can do that. You're going to pay tax on 1031's not all or nothing. Like we said earlier, you're going to pay tax on the money as it comes out. But, and by the way, getting money out of an exchange, it either has to happen at close or after you've purchased everything you have the right to buy. So if you want to pull money out at close, it's got to be specifically addressed in that exchange agreement. So in the exchange agreement and the assignment agreement, really. So what we have in our assignment agreement is there's a paragraph in there basically asks whether you'd like to retain any taxable proceeds. If so, how much? And you write in there, if you want 100 at close, you write 100 in there, it's excluded from the exchange, and therefore you're fine. If you don't have that straight exclusion and you're just taking money out, your exchange is vulnerable. So, really talk to your exchange company, make sure they're aware of what's going on, let escrow know what's going on. If you want to pull money out of close, that's fine. Maybe you have 100 loss somewhere else, and that's going to get you where you want to go. But, the way to get the money out without a tax hit is if you do it in anticipation of a sale. The government's going to say, no, you pulled this money out. If you go into a cash out refi predisposition, that can be looked at as a step transaction, and they come back and ding you for that. If you complete the exchange and then do a cash out refinance, maybe it's a week, a month after, as long as it's separate action, that is not a problem. And the reason it's not a problem is predisposition, the security goes away. post-acquisition, the security instrument stays there, and this is a common tax planning strategy. Now, the other thing I'll say is that, and this is not a seller carry issue, but this is just sort of food for thought. If you sell a property, you own it outright, or maybe you have, a very high equity and you want to go leverage into a number of replacement properties, your choice is to, go out and maybe you sold $1 million property with no debt and you want to go out and buy 2-3 million worth of replacement. Well, it's multiple properties. I'm going to say, let's complete the exchange into one and then do a cash out refi and then go buy the other properties instead of giving up the one and going and buying 2 or 3 with debt. And I say that for a couple different reasons. One, you're not dealing with the headache, that opportunity cost of 1031. You're not sitting there with a timeline that says, hey, I got to get it done. I got an idea at 45 and get it done within 180. You've completed the transaction into that one property, completing your exchange. After you've completed it, do the cash out refi. Now, you have all the time in the world to go buy what else you want to buy. And 2, instead of distributing that low basis off the relinquished property into those 3 properties, for example, your basis on the additional properties purchased with the refi money is the purchase price. So you've got a higher basis, therefore more depreciation, therefore a better return on investment. So I just think it's really important to look at what you're doing, ask those questions, and really take advantage of the professionals in your life to get you where you want to go. So we have actually reached the end of today's class. I hope you found it helpful. I hope you've got some little nuggets of knowledge there. I encourage you, if you're not on our email list, sign up for both the IRA, the 401k stuff, and 1031s. Take a look at our social media stuff and the YouTube channel. They say YouTube's the largest search engine in today's world. Really, if you've got questions on things, whether it's opportunity zones or charitable remainder trusts, or even like I joked earlier about selling life contracts. David, why do you have something to talk about life contracts on your 1031 channel? Well, it's an avenue for money, right? So look at what you got, and a lot of people just sort of give up a life policy because they can't afford it anymore, don't want to pay for it anymore. Well, instead of doing that, sell the thing. Get something out of it. So you've really bought these things. Don't just walk away from them because you don't know what to do. Ask those questions and take advantage of that. But the cost segregation on there too, all kinds of different aspects. But thank you so much for your time today, and I really look forward to hearing from you. Once again, the slide deck will be available. I apologize for our technical difficulties in here. I'm going to have to make sure that the updates are working more seamlessly going forward. The slide deck will come out to you, and thank you so much. Look forward to talking soon. David Moore, Equity Advantage, 1031exchange.com. Have a wonderful day.